want to give you a very, very quick introduction. But let me first introduce, we've got a fantastic panel here. On my left is Patrick Nicosi, Deputy Chief Executive and Head of the Markets and Initiatives team in the Asia Pacific region for SWIFT, as you know, the large interbank messaging system that delivers all the messages and the value payments throughout the world. On his left is Simon Constantidis, Regional Head of Global Trade and Receivables Finance, Asia Pacific, HSBC, really knowledgeable about all the regional trade finance activities. Then on his left is Dr. Ha Jiming, who almost needs no introduction because he is very much a public face of Goldman Sachs China as Vice Chairman and Chief Investment Strategist. And last but not least, Qiao Yide, my very good friend, Vice Chairman of the Shanghai Research Development Foundation, who does terrific work on Chinese and China's financial development going abroad. They did the work on the SDR work and also the Chinese. So I'm going to ask him to say a little bit about Shanghai and the free trade zone area. Let me put the issues in context. The subject is intra-Asian trade, the Renminbi effect. Now, the interesting point is that, of course, the world's biggest intra-regional trade, obviously, is Europe, because Europe is 27 countries, and it's one currency. Nobody talks about intra-US trade. But, the United States got, all these states trading with each other, and that's taken for granted. Now, Asia is different, of course. Asia is many different countries. And the trade, is very, very critical. And, the actual trade has moved up from 41% intra-Asian trade in 2000 to nearly half, and in fact, slightly more than half, 53%, and still growing. So, we all know trade's good for all of us, and that's why there's a lot of discussion, is it going to be, under WTO rules, under, ASEAN, free trade zone, ASEAN +3, ASEAN +6, etc. But we all know because of the global supply chain, intra-Asian trade is growing very, very fast. Now, one of the things that hit us during 2008 to 2009 was the sharp drop in dollar liquidity, failure of Lehman, and as you heard from Richard Koo, it's not that the banks didn't have the money, the banks didn't trust each other, and that sharp liquidity, dollar liquidity dropped. And then, of course, as you know, even though Asia had a lot of dollars, that dollar had to be done through a swap with the New York Fed to get that liquidity back. Now, of course, since the Asian crisis, we've had the Chiang Mai central bank currency swaps, which wasn't used that much during this particular crisis. But an interesting factor is the Renminbi effect. Well, some of you may or may not know, the People's Bank of China has concluded 2.6 trillion Renminbi, that's 426 billion US dollars worth of bilateral swaps with over 20 central banks. And the latest, of course, was with Bank of England, Bank of Indonesia, and European Central Bank. And now, but here's something that most people didn't notice probably. About end of October, the People's Bank, the Bank Negara Malaysia, where I used to work, had a rep office in Beijing open. And the two governors actually announced that the bilateral swap between the ringgit and renminbi would be available to backstop trade finance between Malaysia and China. And actually, even though this is not fully announced, that's possible for the Korean China trade and some of the others that are possible. So for the first time ever, central banks are now beginning to say, when trade finance, is at stake, central banks stand behind it. And that's a tremendous boost to intra-Asian liquidity. So with all these four experts, let me start with Patrick, and then everybody will say 5-10 minutes, and then we'll open up the floor for discussion. Okay? Patrick.
Thank you, Andrew. And first of all, congratulations for this amazing event that you've organized with FGI. About the renminbi, one point is clear, is that the usage of the renminbi in trade, in payments, is increasing. The facts are there. The share of the renminbi in global payments has quadrupled over the past 2 years. According to our statistics, we've seen that the renminbi is now the second currency in terms of value of letters of credit globally. The US dollar, it used to be the euro, it's now the renminbi, with about a 9% market share. When you look at letters of credit that involve mainland China, 30% of the value of letters of credit are denominated now in renminbi. So undoubtedly, it is happening. There are some stats that might paint a different picture. For example, we've noticed that the value of renminbi denominated transaction is on average much higher, but the number of transactions themselves, the share is less, which might point out to, or might get the panel to ask the question of whether the usage of the renminbi for payments and trade is really broad and deep or fairly concentrated. We've also seen maybe some signs of slowing down. That the share of renminbi in global payments has been pretty much flat since June. And that gets us to the point of, for the renminbi to become an international currency, I believe there's got to be economic value for the actors in actually using the renminbi, for the investors, for the exporters, for the importers, for the financial intermediaries. It's got to be as or more convenient than using another currency, as or more safe and reliable and predictable and available. It's got to be cheaper, faster, better in a way than using other currencies. And that gets me to the point I think might be an interesting question, is whether, in order to get to the point where using the renminbi is a better proposition for the actors in the value chain, can the renminbi be a catalyst for broader efficiency improvements in the region? Whether it is on the trade side, on the payment side, or even on the capital market side. It's a well-known fact that there's a lot of fragmentation in the region, and that, to your point, Andrew, nobody talks about intra-US trade, but the fact that we're talking about intra-Asia trade is because it's fragmented. So there are lots of efficiencies to be gained in payment systems, in trade finance, new instruments like the bank payment obligation, for example, and I think it's both a condition and maybe a consequence of the renminbi being a catalyst for some of these broader and deeper efficiency gains in the region. Now the trick is, in a highly networked and regulated industry like payments and banking, in order for changes to take hold and innovation to take hold, broadly speaking, you need everybody to implement these changes and adopt that innovation at roughly the same time. Otherwise, it just doesn't work. And that's where I think we could discuss also the role of policymakers on a regional basis. Private sector, I think, is ready to take on the challenge of improving processes, systems, delivering innovative products, because it's good for everybody in the end. But there needs to be, I think, a pace and an expected outcome that is set by the policymakers for that to actually happen.
Thank you. Good afternoon, everybody. I'll give you some color from a trade perspective on what I see and what we see at HSBC on renminbi. But I ask you to look at trade settlement in renminbi in two dimensions. There is the trade payment, and then there's trade finance. And what we're seeing is there is enhanced and increased usage of renminbi for trade settlement to make and affect the payment. But the uptake in trade finance in renminbi is still very sluggish. I think it was a Swift stat that just came out, that while over 40% of India's trade is with China, only 6% of it is in renminbi. And this is actually a rather common ratio across this region. There are a number of things that make it a little bit challenging. Today, no, we don't think of China as purely a finished goods market. And we heard earlier that it's moving from an export market to a consumption economy. China is becoming much more of a stop on the value chain, a stop on the supply chain, a semi-finished products market. And there are two things that happen with China that was, in terms of impacting how renminbi is used to finance trade with China. One is there's still a significant lack of understanding of what trading in renminbi means in China. We do a number of surveys every year, and the actual lack of knowledge or surveys we do specifically for clients is actually quite astonishing, as understanding and knowing what to do if they want to invoice in renminbi. It's a lot easier to be invoiced in renminbi. But the exporters still struggle to understand what the process is. Actually, they struggle to understand what all the regulation is. And then they have to look at the local regulations, which change as frequently as I change my shirt. And this creates a real challenge for a lot of companies to take advantage of where the renminbi is moving. At the same time as the semi-finished products market, an iPhone might be assembled in China, but the components come from 9 different markets or thereabouts. And those supply chain participants trade in dollars, or they want to be trade in dollars. So really, for trade finance to take hold in renminbi, there still needs to be a greater movement of multiple participants upstream and downstream of the trade supply chain to actually engage and move into that space. 2 years ago, our survey showed us that over 40% of companies trading for trade settlement in renminbi did it because of the appreciation opportunity of the renminbi. And while renminbi usage has grown, the percentage of counterparties taking advantage of an appreciation opportunity has dropped into the 20%. Now that says it's here to stay. The other point I would like to make is the world's second largest economy cannot have its currency sit on the sidelines internationally. It just isn't going to work. And I think while the PBOC has taken a prudent and controlled method in internationalizing renminbi, it's been a very effective mechanism that they've played with. And that will continue, and we won't see a dramatic shift or a shock to the system as happens when currencies start to suddenly float. Yes, the trading band will widen over the near term, and yes, we do think that renminbi will be a fully convertible currency within the next few years, and that will be good for increased trade. But what we also need to see is greater acceptance, greater understanding, and greater activity in trade finance outside of arbitration opportunities. There are also 2 factors that will help drive this. Large companies, multinationals, big middle market, large corporate clients have the sophistication to really come to grips and understand how to do business in a foreign currency. SMEs, and we've heard about the growth of SMEs driving the growth of economic opportunity, creating jobs, don't have the sophistication to understand all the different currency exchange mechanisms, the hedging needs or the hedging opportunities. And at the same time, financial institutions under increasing pressure today to focus on sales suitability. So we won't market a product to a company that we don't think has the sophistication to understand the product. It's not responsible. So the SME market is still going to be challenged to do financing and hedging in renminbi, but we're seeing, I think, to your point earlier, that is it a concentration of activity with a handful of players? And I would say yes. A year ago, we did a seminar in Jakarta, and we had over 132 attendees to that, all on renminbi. I think only 2 of those companies have traded in renminbi since that seminar. So it's a real challenge to get comfortable and to take up an opportunity on it. Our surveys also tell us that over 50% of Chinese mainland companies would give a discount if they could invoice in renminbi. And we hear 3 to 5% discount. And if you think across your total spend in a supply chain, a 3 to 5% discount on the FOB value is a significant savings. So we know the opportunities are there. We have to help companies and businesses understand how to manage the opportunities, but we also need to make sure we put the right products and the right into the hands of the users and not oversell the capabilities. But as China becomes more of an import-driven market, renminbi trade finance will continue to grow, and it will be here to stay for the long term.
All right, yeah. I think the previous two speakers have said a lot about the latest developments of renminbi as a trade conduit. I think at the micro level, I fully agree with the previous two speakers. I think the importance of a renminbi is now moving at a very encouraging pace. I'm sure in the foreseeable future, renminbi will play an even more important role in international trade, and particularly in regional trade. However, as a macroeconomist, I want to say a few words from macro perspective. What are the prerequisites for, what are the requirements for a country's currency to become an international currency or a strong currency in the region, widely accepted currency in the region? I think there are a number of necessary conditions. Right? A textbook tells us that first, size doesn't matter. The country needs to be pretty large. Small countries, even very advanced countries, probably don't even want to see their currency to be internationalized because it's going to be, it's going to reduce the effectiveness of this country's monetary policy if your country is too small. So large country is one of the prerequisites. I think China definitely meet that requirement. The size is pretty large and is still rising. But I would say it's just a necessary condition. There are also some sufficient conditions one needs to meet, one of which I think is a strong economy. The strength of the economy also needs to be there. Size is not everything. Size does matter, but it's not everything. Then I would say, at present, the Chinese economy is probably not strong enough. There are some very significant weaknesses in the Chinese economy. I would say there are a few fault lines, structural fault lines, that China needs to first address before its currency could really become a widely used regional or international currency. I would say one fault line is the significant imbalance of the Chinese economy. If you look at the Chinese economic growth pattern in the past 2 or 3 decades, it's mainly driven by investment and export, whereas consumption play a very weak role. So as a measure of imbalance, the share of investment in GDP is now as high as around 50%. 50%, what's the concept of 50% investment ratio? Well, the previous peak in China was 42% in 1958 during the Great Leap Forward. I know that 42% was extremely high, and that was followed by a sharp downward adjustment of the Chinese economy in the years that followed. Namely, from 59 to 62, China's economy experienced a huge hard landing. So, imbalanced economy, if not corrected, could lead to quite significant downward adjustment. So I would say today's 50% investment GDP ratio is probably too high. Not just higher than China's historical norm, but also higher compared to many other high-saving countries. For example, that ratio in Japan and Korea peaked at 40% in the 70s and 90s respectively. But in both cases, the economy created huge glut in those two countries that were corrected subsequently in the following years. But the correction, we know, is quite painful, I have to say. So imbalance of the economy is one fault line. The other fault line is unfavorable demographics. In the past, the Chinese was pretty young. When you have a young population, the savings rate is high. So you tend to generate a lot of current account surpluses. And a few years later, you find that you have a huge pile of foreign exchange reserves. That's why your currency is appreciating. When your currency is appreciating, everybody wants to hold your currency. But there's an inflection point in China, according to my forecast. After 2015, China's population will start to age, and savings rate will go down, and China could become a deficit country when the exchange rate may not appreciate. And Chinese government also does not want to see its currency always appreciate. It wants to see a more flexible currency. By that time, it could depreciate. So the question is, will people still want to hold a depreciating currency? And that's probably not a cyclical depreciation. It's driven by some fundamental structural factors. And these factors are unlikely to be changed, even if there's a policy change. For example, if you change the one-child policy, and you need to wait for 15 or 20 years to see the Chinese demographics start to improve. Before that, it will further deteriorate. A third fault line, I would say, is pollution. I just flew from Shanghai back to Hong Kong yesterday. And I was in Hong Kong for 2 days, in Shanghai for 2 days. You know, people know in Beijing, the air quality was bad. But now more and more places see this kind of a PM 2.5 index rising at a very scary level. So I would say China at current stage needs to clean up its financial, clean up its physical assets, clean up its air. So a lot of work needs to be done for the country to grow at a healthy path to make the country strong, not just large. And now, finally, I would like to say there are also financial restrictions that impede the currency to become a full-fledged international currency. For example, capital control is still in place, and interest rate is still subject to pretty tight regulation. If you have these kind of regulations in place, it's difficult to make your currency an international currency, because first, you don't have a well-developed bond market. Why people hold your currency? What are the vehicles that people can hold your currency? You can become a widely used currency in international trade, but as a store value, currency still doesn't have enough strength to attract international investors to hold your currency. Right? You can use your credit card to trade everything, buy everything, but people don't hold credit card as a store value. Right? It's different. So I think China doesn't want to give a free lunch, just use my currency as a trade vehicle. Ultimately, China wants international investors to hold its currency. To achieve that objective, you need to develop a bond market so people will have something to hold your currency. I will stop here. Thank you.
Thank you. Ida?
I just want to follow in what they say. I want to make some point from a little wider perspective. First of all, as everybody knows, the base of any currency has to be supported by the economy. Actually, China has a big impact on the economy of the rest of Asia than some people expected. particularly to us who are living and working in mainland China. When we read an article in Chinese newspaper, which always describe what's the impact of tapering unconventional policy from developing countries on Chinese economy. But actually, we are not aware another round also existed. In October, I attended joined the conference between IMF and the World Bank in Washington, D.C. I was very impressed with what Minister of Finance in Indonesia said in one session on Asia-Pacific economy. Basically, he said, not everybody talking about the tapering of unconventional policy, but actually, the slowing down of Chinese growth have a more negative impact on us than tapering of unconventional policy. Why? Because we export, among our export, 60 to 70% on commodity. If Chinese economy slow down, we export, we will slow down. I guess that's the one channel of Chinese economy have impact on the rest of other Asia. I identify another two channels. One is China in the position of pivotal position in supply chain, because China import parts from Japan, South Korea, Taiwan, and assemble them and export to US and Euro area. And another channel is along with the income increasing in China. Also, Chinese economy now is transferred to more domestic consumption oriented. So in China, there's more need for consumption goods. So that's I guess we should understand the Chinese economy play a bigger role on the rest of Asian economy. Related with that point, China has been trade surplus for many, many years, generally, totally. But I want to emphasize here, actually at the same time, China has been in deficit position to the rest of Asia. That's very, very important for renminbi going out, because in any country with a deficit of trade position, it's meaningful for them to provide liquidity to their counterpart. That's the reason why in Asia, more people are using renminbi as a settlement currency than other regions. I guess along with the trade increase, the renminbi will be used more widely in Asia. The last point I try to make is investment also play a very important role for cross-border use of renminbi. Recently, President Xi Jinping have a visit to some ASEAN countries. He made an announcement in Indonesia. China is planning to set up a 50 billion investment fund for infrastructure in Indonesia. I think that's a good idea. Also, it will create a win-win situation. On the one hand, it will help other Asian countries to improve their infrastructure. On the other hand, that's the way to reduce the overcapacity of China. Also help renminbi going out. I think China should go this direction further. I guess I stop here, maybe waiting for a question regarding the free trade zone in Shanghai.
Well, you've anticipated that, so I'm going to ask you. Since you're from Shanghai, so we want to hear from you how you see its development, what the issues are, and what are the prospects. Ida,
yeah. That's a hot topic for the free trade zone in Shanghai. I want to remind you, particularly several days ago, on December 2nd, PBOC make announcement on the guidance to the financial support FTZ in Shanghai. They call the financial 30 item of guidance. That's guidance people waiting for almost more than 2 months. That's critical. You know why? Because FTZ in Shanghai is, I guess, totally different from other FTZ over the world, because the FTZ in the other country usually just concentrate to facilitate trade, facilitate investment. But in FTZ in Shanghai, they're including some very important component of financial reform in the zone. That's I guess, the most big difference between the FTZ in Shanghai and the other FTZ. I figured out these 30 item of measurement can be, scattered over the 7 sections. First section is the principle. Second section, the establishment of free trade zone account. Then the last one is related with the regulation. But the core component of the guidance is 4 items. One is the facilitate of investment, financing, and the currency exchange. The second one is the increasing cross-border use of renminbi. The third one is the liberalize of interest rate. The last one is strengthen the management of foreign exchange. That's the 4 most important component. I figure out that there are 2 most outstanding features of these 30 items. One is we call the first line will be dismantled. First line means country border. Financially will be deregulated. The second line, which means is the district line, still under the control with limited capital inflow allotted. That's, I guess, it's very important outstanding feature of these 30 items. Second one is this guidance encouraging capital flow from China, go outside, rather than encouraging capital flow into China, particularly through the district border into the inland China. This second line, I guess PBOC is still very cautious on any capital inflow into mainland China. But of course, they have some limited permission of capital inflow. For example, any residents or company, including foreign one, can make equity investment into any security market in China. Originally, it wasn't allowed. You have to put in QFII in order to make a security investment. Now, any foreigner, non-resident, if you have a business or living in the zone, you can make such kind of equity investment. I guess that's my answer.
Thank you very much. That's quite an opening, actually. That means if I'm a multinational, I establish in FTZ, then I can actually remit in renminbi not through a QFII scheme, not through an RQFII scheme, and I can make some investments. Yeah. So as some of you know, the RFQII scheme is that if you hold renminbi offshore, you actually are now allowed to invest inside China through that scheme. But the People's Bank has actually liberalized, and correct me if I'm wrong technically, because this is very, very, very technical. If I am doing FDI in China and I possess renminbi offshore, I can remit that back into China to invest in renminbi. Is that correct?
But the investment have to be in the zone, have to back to
okay.
the Eurozone.
Okay.
But still, any money used through to other accounts or other people regarded as a foreign exchange, still under the control, under the regulate, unless same non-financial institute, they have a different subsidiary. Yes, if you have a subsidiary registered in the zone, you can get cheaper money, for example, from Hong Kong. But you can use this money shipped back to your company registered in mainland China. They have a limitation. You cannot make investment in security. You cannot, some restriction on that. But definitely you can make an investment to your home company. Or you can return loan. That gives some little limitation.
So largely still basically cautious on the capital account, but on the current account, basically, pretty open. That's essentially the game. Okay, Patrick, Simon, or Jimmy, would you have anything to add to that? Or?
Yeah. I think, a lot of people likens the Shanghai Free Trade Zone to the free trade zone at the early stage of China's economic reform, like the one in Shenzhen. But I think things are quite different. You don't experiment financial reform from a region. It's impossible. How can you liberalize capital account starting from a region? If it's a goods transaction, fine. You have a bonded zone. You can make it VAT free. You give tax privileges, and all the goods go in and outside of the zone can be monitored physically. But with the financial transaction, you just hit a button that the money will go anywhere. So you do experiment, fine, but the experiment, like Ida just said, is constrained to the transactions from outside of China with the zone. But the zone itself is just a 28 square kilometer, a very small area. Yes, residents from this zone can invest abroad, but the thing is how many residents there are in this zone. This is not a very populous region in China, right? I don't know whether you've been there. So it's very difficult to understand the concept. I think China needs to press ahead with financial reform, not just to start with the zone. The nationwide reform needs to take place. It's probably already overdue. If you look at the decision, which is the official document from this third plenary session, I've read this over 21,000 words documents, word by word, very carefully. I read it, and I found that not enough emphasis has been placed on financial reform. For example, there are 16 chapters. Now, the first chapter is a guideline, which says everything, not everything. Significant progress needs to be made by 2020. Significant progress meaning of the following 15 items. Then you read the following 15 items, you find that the financial reform is embedded in one of the 15 reform tasks as a subsection. Whereas many other reforms, for example, fiscal reform, is a standalone section. So that gives me the impression that maybe financial reform is not going to play as big a role as many people anticipated. Otherwise, why this is discussed in such a light way? Why this is not given enough weight? compared to other kind of reforms. Right?
There's a possibility, maybe a big disagreement on the issue.
Exactly. So there are probably controversial issues. A lot of things need to be sorted out. But I think China has a very strong, very significant financial depression. Right? Households' savings are only earning interest rate below inflation rate for many years. That's why households cannot consume enough. But investors, corporates, local governments, developers can easily borrow money and overinvest. That's why the Chinese economy is so imbalanced. So financial reform is overdue, and it needs to be carried out without further delay. Before that, I think Renminbi internationalization is still a few steps away. There are some prerequisites we have to meet first.
It's very good, Jimmy. You can see that we're getting a little bit more lively now. Slight disagreements. Great. Patrick or Simon, you any comments?
Maybe briefly on the Shanghai FTZ. I think many of us watched the policies and certainly the guidelines that the PBOC issued about Shanghai FTZ 2 days ago seem to indicate that there's a broad range of activities that can be performed there. But I think sometimes we need to remind ourselves that although policy changes and domestic reforms are a condition for the renminbi to be used internationally, that's not going to be the only deciding factor. Again, the exporters, the importers, the investors, the intermediaries need to see value in there. And I think there's a lot of work to be done, and there's a lot of work that needs to be done that involves other stakeholders outside of China, in the region, throughout the world. And I think there needs to be really a policy of embracing some of the best practices that are used across the world. For example, today FX settlement risk has been basically eliminated thanks to CLS, a bank that settles FX payment versus payment, eliminates settlement risk. The renminbi is not settled in CLS yet. That's important to embrace these international best practices. And another example is, I was talking to a banker in France, and his customers were trying to pay their suppliers in renminbi. So he was routing the renminbi through to China. The payments didn't go through, there was something wrong in the code. The bank received an error message back in a CCC code, which is a translation of a Chinese character, and they had to interpret that to go back to the customer so that the customer could give more information. Basically, the payment never happened, and that customer in France that was trying to pay renminbi will probably wait a few years before trying a second time. So it's got to translate all the way through globally down to the detail as well for the renminbi to become used really globally and internationally.
I think echo the doctor's comments here. No, size has a role to play, and 28 square kilometers is nothing. And I'm actually quite surprised the amount of focus and attention and excitement this gathered in the media. And then a month or so later, everyone goes, okay, we've got a free trade zone, but we don't know anything about it. We're going to create a free trade zone, but we're not going to tell you what you can do. And 2 months later, it comes along. I think what's more exciting, to be honest with you, from a trade perspective, is the AEC coming together in 2015. And as the ASEAN bloc comes together and creates the AEC, and what that will do in creating opportunity in terms of if it can reach its 4 pillars of movement of labor, reducing the competitive nature between ASEAN countries and becoming together as a more cooperative trading bloc. You've got 600 million people within that trading bloc and a $2.5 trillion GDP, and as a bloc it would be the 8th largest country. It's going to dwarf, in terms of potential, of what China will do with a free trade zone. You'll have countries within that trading bloc that compete head-on with China, from low-valued merchandise all the way up as they move up the value chain to industrial machinery, infrastructure, consumer goods, electronics, agricultural, energy, etc. And it seems to me a little bit strange that everybody keeps on China, China, China. And ASEAN's only around the corner, we're not talking enough about it. And I think that's more exciting than the FTZ.
Great. I think, let me put a little bit of perspective. I just want to stir things up a little bit. You know, don't believe anything I say, okay? I'm just posing the question. The point that you made, I think, I think it was Ha Ji Min who made, was that China runs a current account deficit with the Asian region, okay? China is a big importer of commodities and semi-components, and therefore, sorry, Yida's point, right? This is very significant. Why is it significant? Because the partners are now holding more and more renminbi, right? And if they hold renminbi, de facto that renminbi is offshore, correct? So let me just give you a very interesting sign, right? The minute that renminbi agreement was signed with Taiwan, you know, Taiwan became a very, very big, important renminbi center. So now, actually, you reflect on this and you think about it, well, that's exactly what happened to the euro dollar. There was a lot of dollars for people who held dollars in Europe, and then they started trading, you know, within Europe, and then American companies then started borrowing euro dollars, and then invested elsewhere. So to a large extent, you know, the very fact that foreign central banks are now willing to hold renminbi as official reserve, not that liquid, but they have this swap arrangement so that when they hold the renminbi, if they need the dollars, they go to PBC and it just says, you know, swap the dollars for me, or euro or whatever, right? So, you know, you are actually beginning to see the steps of moving out very much like the dollar, euro dollar, you know, it took 70 years for this to happen. And that's why that prudent, slow opening up is important. It does take time, and it will not be easy because there are so many details to be dealt with. And I share that caution of Jimin, but I also think that, you know, Yida's got it right. This is an experiment. You need to actually deal with the micro as well as the macro, right? And you can't not pay attention to the micro issues. So I'm provoking this and see how Jimin and Yida and everybody else thinks about this issue.
I think that's an interesting point. What I would like to highlight here is the fact that China always copied the US monetary policy does not make China's own currency a substitute for the US dollar. Other countries can hold the dollar or renminbi. So renminbi needs to differentiate it from the dollar. When the US monetary policy is too loose, China does not follow it. But the matter of fact is that look at what happened in the past 5 or 6 years, starting from 2008 when the US monetary policy became very loose, very expansionary. China's monetary policy was even more expansionary. Money growth was even faster than the US. But the US the economy had some problem. It was sick, taking some pills. The Chinese economy is not so sick, but it also takes the same pill, but in a bigger dosage. So you copy US monetary policy. Why? Tell me the reason why I need to hold your currency if you cannot differentiate yourself from the dollar. I would rather just hold the dollar. You're completely correlated. Right? So I think China needs to have its own independent monetary policy. Make your currency fully flexible. All these prerequisites need to be met. I'm not saying China's currency will never become a national currency. It has the potential because it has already met the necessary condition. The matter is that the thing is you also need to meet the sufficient condition. Open capital account, full convertibility, full market determination of the exchange rate. And to achieve these objectives, it's not just PBOC change the policy. Exchange rate can be market determined, and that's it. I think a lot of market participants also need to follow market rules. If you still have SOE as a main body of the economy, as stipulated in the decision, it's difficult to imagine you can have a efficient or fair market. What is a market? Market is not an abstract concept. Market is formed by many, many profit maximization business entities. If a lot of the participants in the markets are not maximizing profits, but maximizing output or something else, you're not going to have an efficient market. I'll give you a very simple example. If you have a market determination of interest rate at a level of 6%, and the private sector has an investment project with a return of 7%, of course you want to borrow. But the public sector, SOEs, only have a 5% return project. But they also borrow. I don't care. Loss making, that's not my problem. I just keep borrowing. They're driving up interest rates to 8%, then the private sector will stop borrowing, but the public sector will continue to borrow. They don't care because they're not profit maximization. What kind of market is this? Even market price, in this case, interest rate, is market determined. It's not a healthy market. I think market determination of factor prices is necessary, but it's, again, not sufficient to have a healthy market economy. I believe before the 1997 financial crisis in Asia, a lot of the countries have their market price, have factor prices determined by the market already, but they still have experienced terrible crisis. I mean, in the 70s, in the 80s, Japan, you also have market determination of virtually all prices, but the Japanese economy still experienced very weak growth in the 2 decades that followed. So I think that China, factor price reform is one thing. I think that's very important. It's been realized by the government. But correcting the rebalance, change the mode of economic growth, that's even more important. But I'm afraid that's not well addressed in the recent policy moves.
Okay, Lida.
Jimmy mentioned the independence of the PBOC monetary policy. I guess what he say behind what he say is theoretical base we call Mundell framing dilemma. But I wanted to provide some information on that. In August, Jackson Hole conference organized by Federal Reserve, the professor from London Business School, Henry Ray, presented one paper. The title called Trilemma or Dilemma. Her conclusion is trilemma doesn't exist anymore. Actually, in the world, only dilemma. Either way, you follow the federal policy or you management capital account. That's the only choice you can make because the world economy changed. Now is they call global financial circle. You look back several years, whatever changing monetary policy of Federal Reserve have a tremendous impact on the rest of the world, not only China, Europe, Japan. The argument is challenging. I don't know whether I totally agree with that, but at least he indicated the fact the short capital inflow, outflow creates some problem for economy, particularly for small country economy, like Stan Fisher mentioned that in the morning. I guess that's the theoretical issue for us to have to continue explore or study.
Okay, time to open up to the floor. I think we've got enough of a big debate. Robin, why don't you start?
I think everyone can hear me now. Oh, no, okay. So 2 quick questions. The first is just a really short answer, Hashiming. You're pretty pessimistic on a number of fronts. What percentage chance would you give that China actually experiences a very hard landing or crash in the next 5 years? And second question for Patrick, you guys have a really great, it seems to me, measure of the global economy that none of us really see. And I just want to ask you to do a reality check. We've heard a lot of economist projections for growth rates in US, Europe, global, Asia. And from what you can see of money flowing around the world in trade, where do you think the global economy is? How fast is it growing?
I can give you a very, very short answer because this question is so difficult to answer. 50-50.
You think yours is difficult? we do correlate our statistics with GDP growth, and it seems that there's some good statistics that can come out of that. But I wouldn't want to make any predictions. What we're seeing is in our data solid growth this year, which seems to be looking positive for the coming months. But I would rather leave this to the economists at the table.
Okay, next question. All right, right at the back, and then in front. Okay. Yeah. The mic's coming to you.
Question on behalf of the financial community in Hong Kong, since we have a lot of worries about the free trade zone and the policies in China, how we're going to sustain as a financial center ahead of the curve. I think, Mr. Jing, you mentioned about bond market. Obviously, bond market needs to have liquidity, needs to have maturity, the yield curve out, and of course the outstanding issues to make the market tradable, investable. When do you think Hong Kong will have, incidentally today, Far East Horizon issue of 700 million RMB bonds, 3-year at 5.45%. When do you think Hong Kong will have a chance to issue a similar type of credit, at least 10 to 15 years out, with about 2 billion outstanding issue? When do you think we'll get there?
Well, I'm not a bond market expert, but I think Hong Kong can continue to play a very important role for China's issuance of both sovereign and corporate bonds, be it denominated in dollars or renminbi or other currencies. Because China's capital market in the foreseeable future, I think is still going to remain pretty much closed. I don't think, I think China needs to strike a very careful balance between the efficiency of the market and the safety of the market. According to IMF study, financial liberalization in many countries lead to financial disruption. So on the one hand, I think China needs to further open up its capital account, but at the same time, the pace will be constrained by the concern about financial disruption following a too fast opening up of the market. So I think in China there are different thoughts. That issue is also quite controversial among the think tanks and policymakers. As Ida mentioned, why the decision didn't give enough weight to financial reform. There are, of course, there are reasons. So I would say Hong Kong still has a advantage over even Shanghai or other parts of China in terms of issuing bonds for the mainland entities. And Hong Kong itself, I think, Hong Kong itself, it's difficult to see Hong Kong has a sovereign bond because Hong Kong government has a very strong fiscal position. You always have fiscal surplus. So that in that case, you don't need sovereign to issue sovereign bonds. But corporate bonds here, I think still is still has room to grow. So I would say Hong Kong, on the back of China and also the unique position as an international financial market will continue to join the position as both the equity and bond market for the region. I mean, as a center for the region for many years.
My question is to Simon, and I was wanting to ask on the SME piece, is it possible that you can get a product which integrates finance, payment, and settlement for them, independent of the big boys? Because as an engine of growth, they are part in what's making this trade happen. And they probably don't produce the macroeconomic risk that Dr. Harming is talking about. Can the destinies be separated and see something for SMEs first before they come for the big boys?
Yeah, I think there's a lot of SME financing going on, although there is work being done to say there's a shortage of trade finance into the SME market. And that's typically, I think, probably at the lower end of the market, and the private sector banks are selective in where they want to play in markets from global multinationals to large corporates to MME. But I think the important thing is the financial sector has a responsibility to help SMEs grow, have a responsibility to help them contribute to the real economy and create jobs. And therefore, banks today are much more cautious than they were before the global financial crisis as to what products they want to put into those businesses, to the point where I made earlier about not misselling too complex a set of products to the clients. But there's always, in trade, there's risk management, there's finance, and there's liquidity. Those are three common components, and foreign exchange. So yes, there is the ability to help and work with the SMEs to make sure they understand all four components technically, but the three primary ones, and then say, okay, what's a different model as you grow, that now you can start looking at alternate currencies in terms of where you're doing business as well.
Yes, briefly, I think to your question, there's also an innovation that the awareness might not be that widespread yet. It's called the bank payment obligation, which is a concept that was endorsed by the ICC last year. And it is really a new instrument in trade finance that is not as cumbersome as a letter of credit, but provides some risk mitigation and financing opportunities that open account settlement doesn't offer. And I think that's one of the examples where, together with the regionalization of the renminbi, we can have the renminbi be a catalyst for the adoption of these these new products and services, and that the banks can deliver on the back of the BPO to be adopted broadly in the region.
I just want to make, I think that's a very, very good point, and I just want to make a sort of advertisement. In the Oliver Wyman FGI report, there is a section which says what we really need to think about if we want to help SMEs is to integrate the internal trade and the external trade component of that processing. And today with ISO 2022 and the BPO, as Patrick has said, it's possible for the central banks working together with the banking system to design this in such a way that for the SME, it's one pass. It's not, look, I'm going to trade with you internally in renminbi, and then suddenly I go and buy an LC, for import or export externally. Today, everything can be integrated electronically. Now, this was the system that actually helped the Germans strengthen its Mittelstand, because the Bundesbank used to do this. The Bundesbank would discount the bills of the Landesbank, who were the local community banks, which helped the SMEs, do this within the Deutsche, in those days, the Deutschmark. But unfortunately, under the EU, they dismantled the system. But I think that's a scheme that actually we apply this in Asia, and we adopt the same standards, right? The same sort of protocol. We can get this through regional currency, and exactly as Simon says, with the rise of the ASEAN economic community, and maybe ASEAN +3 and maybe ASEAN +3, this could actually strengthen completely, with no political undertones, the supply chain trade financing, SME financing, one pass. So So that's just a suggestion that we've made, and we're hoping the other central banks will, all the central banks will listen to this. Anyway, one more question. Anybody? Yes, Tad, why don't you do that, and then after that,
A question again to our two mainland speakers. And you're both sort of cynical in questioning the Shanghai Free Trade Zone, saying that it's more form than substance today. The question I have is, could it evolve into something we don't expect, like a booking center, rather than a manufacturing thing? So it could be used for re-import, re-export, could be used as booking financial transactions that take place outside of the zone. And how do you think about this evolving? Because again, I don't think we should think of it in terms of Shenzhen. So I'd love to get your reaction to that.
I guess for manufacture, I don't see a much advantage you put into the zone, unless you focus your export to overseas. That makes sense. Otherwise, I don't think you should move your manufacture into the zone.
I think this zone can provide opportunities for opening up China's service industry. I think that is a very useful role for this zone to play. But in terms of my point I made before was, in terms of capital flow, it's difficult to use a zone as a pilot for capital, for experimenting capital account opening. And that's very difficult. You can say, the first thing is to define how much money from the rest of the country can be transferred into this zone. Once you decide that parameter, then the money can go anywhere in the world. But if that's similar, that's going to be similar to QDII, right? So it's a repetition of what China already has. So I think the importance of the zone is probably can foster the development of some services industry that China should and need to open in the future.
Simon, you want to say something?
I think it's a very good point that in a small geographic area like that, you can't stick a very big factory, and it's more expensive. I think there is one goal that is quite interesting, and that is to help drive the trading of commodities. And therefore, the question would be, can it compete with Singapore in terms of rule of law, in terms of free flow of currency? ICBC is the clearing bank for the renminbi, and 5% plus of Singapore's trade now is settled in renminbi, and that's where all the trading companies are in this part of the world. I would actually think that rather than competing with Hong Kong, how does it compete with Singapore? How does it take on the maturity of Singapore? Because we have to question the rule of law. The legal processes are long and outdated. Yes, it's got a port infrastructure in China that's very advanced. Singapore keeps on growing. And what does it then do to spur other countries to create similar opportunities as well? So, I certainly don't think you set up a factory in a little place like that.
I agree. Okay, your point. And then finally, one last from the lady at the back.
Coming from Germany, I would like to ask about speculations we have at the moment of a renminbi hub in either Frankfurt, Zurich, or London. So what do you think about these speculations? And on the other hand, how much interest would China have in such a renminbi hub outside China in Europe? The question would be on Dr. Hajiming.
Actually, I don't have on top of mind all these data. I know China is opening up more renminbi centers, starting from Hong Kong and Singapore, London, maybe some other European countries. I think over time we'll see more trading centers being established, and renminbi will be more widely used in the region first, then also in other parts of the world. But I think the ultimate objective for a country's currency to get internationalized is not want to give a free ride to other countries. Please come use my currency. What's the point of using your currency? You ultimately want to have those people, those countries, include your currency in their foreign exchange reserve. You want them to buy your bonds when you need financing, when you need to finance your budget, when your companies need to mobilize capital. Foreigners would be willing to invest, to lend the money to you. So you need to have this kind of instruments for them to invest in you, either in your government debt or in your corporate debt. So I would say China needs to develop its bond market and also at the same time allow foreign investors to invest in its bond market. Again, the gentleman before asked the question, I think Hong Kong has and will continue to play a very important role to facilitate this. And I think until China can have a quite significant bond market, there is a limit to how much this renminbi can go around the world. Yeah, you need to have your currency, you don't want people to hold your currency just think, oh, tomorrow you're going to appreciate. Then the question is, if they think tomorrow you're going to depreciate, they're going to dump your currency, and that's too bad. Right? So I think China definitely needs to avoid that. Thank you.
Okay, last question. Mike there, please.
Yes, this is a question, I may be right or wrong, but referring to the lecture by Professor Stanley Fisher this morning, I think he was referring to the Triffin dilemma. That is, when a country grows too large, like US, its surpluses will deplete, and you get into a current account deficit. So the danger now for China is that should China take the same path in its growth? And the question is, if China were to grow and it can become an international currency, how can we stop it from being a true reserve currency?
Anybody want to try to answer that question?
My feeling is there's a difference between average reserve country and major reserve country. Why? For example, United States is a major reserve currency. It will come across Triffin dilemma. But the other reserve country like Germany, Switzerland, not necessary. You can look at the balance sheet. They are surplus, but their currency are reserve currency. So I guess if China renminbi just become one of reserve currency, that's fine. If they wanted to replace of US, that's different situation.
Thank you very much. Well, I'm afraid we can carry on this forever, but we have to stop sometime. If I may sort of ask whether any of my participants, panelists would want to have some last word. Anybody? Okay, so let me just very quickly sum up. You've now heard that even on the renminbi, some of our mainland friends have very, very different views. So, and I think, this is a very difficult subject, but by and large, I think the internationalization of renminbi is moving forward in steps. As I said, the very fact that a number of central banks around the world are beginning to hold renminbi, even though it's not on a capital convertible account, and the swap arrangements that the People's Bank has done has mean that the liquidity of the renminbi, both domestically and internationally, will be impacted on and will have implications on global moving forward. So thank you very much for coming this afternoon, and we look forward to you joining the next session. Thank you very much indeed. And let me thank all the panelists.